Hey guys, welcome back to the channel. I hope everyone is doing well. Today I have yet another Zago managed fund that could be potentially coming out. This time this is the Defiance Treasury Alternative Yield. Now I was wondering if this is really trash or if it's really a Trojan horse for QQQY variants. So let's dive right into it. So the first thing when I was looking through the preliminary prospectus is that like why is Defiance working on this? But then I thought like, well, maybe there's something up their sleeve. So if you look at this, the Defiance Treasury Alternative Yield ETF. Okay, so there's first like there's no expense ratio yet for this guy. So, but if this is meant to be like a kind of like a risk-free like parking spot for your cash, so maybe like 5-6%, since like regular treasuries are just paying like 5%. If they're adding like these option products on top of it, you can probably bring it up to maybe 6% or so. And here's where it gets really interesting for me. So they're starting to use like, well, this like technically for experienced option trader, these aren't really that fancy, but I think it'd be fancy for like most retail traders or investors. So this product is meant to be sort of like a safe, quote unquote, fund. They're using 1 year or less treasuries. So when you first look at it, it's not that exciting. But then when you start looking at the fine print, like what they're, what they could be potentially be allowed to do. So, this 100% of the net assets are a combination of option strategies subject to the following ranges. 0 to 50%, get this, debit spreads, calendar spreads, diagonal spreads. These will probably be like the first time Zago's rolling these out through either Yield Max or Defiance, if this gets approved. And then like straight up puts on calls on Treasury ETFs. And then, potentially like the rest of it could be put into credit spreads. I want you guys to think about this. Like right now, the the general VIX environment, just for regular stocks, it's not that great. It's actually trending down. So if let's say like the VIX gets even lower to let's say like around 10%, a lot of our yield max and like the Defiance, like the zero DTE funds, I'm expecting like a like a kind of like a dip within the overall yields. And then what if the Fed starts cutting interest rates next year? Now that will also be like a kind of like another double whammy. Well, for stocks, but for potentially treasury and bond products, this means that like the bond prices could potentially be going up. So this is actually a smart way to kind of play on it because they're already setting the stage, and I think they're preparing something. This is why they start using debit spreads, calendar spreads, and diagonal spreads. Now, for those of you that are new, uh, in a low interest rate and also a low volatility environment, this is where the debit spreads, calendar spreads, and diagonal spreads like start to shine. I'll probably go over this in a future video if there's demand for it, because I think sometimes like when you're first exposed to these, there's a lot of lingo, uh, that goes into a lot of jargon, and I hope like this video will help maybe kind of set people's minds at ease, because I want you guys to like start thinking ahead, because even though this is just like a treasury product, this might just be like the first foray into like these type of new spread combinations. And again, just going through like the document again. So it's managed by the same folks at Zago Financial, so nothing new here. And this is kind of like my conspiracy theory guy coming out. Uh, so I think it's actually pretty smart from a manager's perspective. Like you want to kind of bring out like the boring and the safe stuff first, like basically treasuries. This way, it gets the public like kind of used to this type of product and like the type of like the strategies that are being used. But then I want you guys to think ahead. Then like if like this treasury product is approved, then they could start bringing out like more interesting products, then when they can start bringing out like the big guns. This way, like if the like let's say like they start bringing out like debit spreads, calendar spreads, etc. On let's say like the triple QY type of product, but instead of using a cash secured put, what if they start using like okay triple Q DB like for debit spread? Now at first you might not think like it's very exciting, but this gives us like more opportunities to profit because like the triple QY, it's only going to do well in a kind of like a high interest rate environment and also a high volatility environment. But for debit spreads, like if my thinking is correct, where like the volatility is going to be low, this is where the like a say like a triple QDB. And I'm just like throwing out like random ticker symbols because that's just my guess. If they decide to bring these type of products out, this way they can say, oh, well, if the SEC like starts looking at the prospectus and saying, well, this might be too risky, then they could go back and say, well, they can also appeal and say, hey, but you let us do this before. So it really hinges on if this treasury product is approved. Like this particular product isn't that exciting, but if this is really a Trojan horse, oh man, we can be looking forward to like different triple Q, like a different version of JEPY, a different version of IWMY, and then whatever zero DTE product that's out there. But the thing is, like, we have to kind of get like the general public to kind of understand this stuff, and that's why, like, if you guys can please like and subscribe, push this type of content out because the general public, I think that's what we need to like kind of win over. Like, chances are, if you're already a subscriber, you're already pretty smart, and you probably know this stuff already. But this is where like the general public, I mean, you still see like dumb comments in like the comment section sometimes. Not just mine, but like other people's. Like the bigger YouTubers, like the comment section, like, oh, these products are too dangerous. Never rules, and blah 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 blah. Like they still don't even understand just like basic covered calls and cash secured puts, and this is why, please, like, you know, I think we can win people over time. I think we just have to kind of keep hitting them over the head with this kind of type of content because this is so important. Like, especially when you know, like the job market is kind of starting to get little mediocre again. So these type of yield products, this is very important for people to like. I'm not saying like you can like retire on these products and like next year or something, but if you give people enough time to compound, this will help people with like supplemental income and people that are like starting to enter like retirement age. That's where like I think these products, especially if they can keep innovating, I think this is where like the general public will really benefit. But of course, like I don't want to get ahead of myself. First things first, we need like I guess like education, and then we also need to like help like spread the awareness. Um, because I think like in general, like the Defiance and Yield Max products, I think over time the yields will kind of trend down if my guess is correct. But But anyway, that's just like me and my soapbox. So I'll step down now and like start kind of going like what the potential, um, I guess like more about this particular product. So there's like these less than 1 year Treasury ETFs, like according to the prospectus. This is where I guess they're planning where to kind of use the debit spreads and calendar spreads, etc. So CLTL and then SGOV, these treasury ETFs have no options. So I think they're probably not going to use these unless like the market makers start like creating option chains for these guys. But so far, then there's SHV, BIL, and then GBIL. Now these products have been around for a little bit, but I guess like the best bet, uh, if my guess is correct, is that they'll probably maybe use BIL if they plan to stick with less than 1 year Treasury ETFs. But this is where like I'm kind of guessing like the additional yield from selling either credit spreads or debit spreads, like you're probably not gonna get much because you're gonna have to do like maybe like 100 contracts or something like that just to get something decent. Because look, like if you look at the out of the money strikes, like even like at the time of this recording, the price for this particular ETF is 91.53. With this, like even if you go to like the 92 strike, which is like the next closest one, look at the bid and ask. This is ridiculous. 0 and 5 cents. How are you gonna make money with this? And this is where I think like they were probably looking at these as well and going, well, we can't do credit spreads, so we're probably gonna have to do debit spreads. So if they do like a kind of like one strike in the money, like this 91, um, using, buying this 91 and selling the 92, uh, again, this is terrible because like you're not gonna make much of this. And then if you go to the put side, it's the same thing. Like maybe you can get like 5 cents on the 91 put. And then over here, like, I really don't see how they can, uh, at least like for the long term, get away with this, unless like there's a lot more volume coming in, to help. So that's why like the actual ETF itself won't be that exciting. But I think if they can kind of like push the envelope on, let's say, expanding it from like less than 1 year to like other treasury products, because like TLT is the one where I think a lot of the volume is. Like for example, this is 44 million, versus like 5 million for this little guy. I think this is probably where like you can start seeing like, well, maybe there's some opportunity if they tend to, if they're really gonna stick to like treasuries, they'll probably have to go out like further out in time. So like these will be like 20 plus years, unfortunately. So they'll probably have to push the envelope on how they want to uh, do this treasury product. So this is just an example, just for people that are new, where like you've never seen like a debit spread before. Um, and this is where the name comes in handy. Like a credit spread, you're getting paid upfront to do the trade, but you have like the obligation later if if it goes past like the short strikes. But for like debit spreads, you're paying money out first. Now, and then if your trade goes successfully as you hope, then you want, and then that's where like you get paid. So using this TLT trade for example, let's say you buy the 94 option and you sell the 95 option. You're paying out $50, but if everything goes well, and the let's say the price at the after this expiration cycle, it goes to like $95 and like 50 cents or something like that. Then the difference, like you get paid like the difference between the strikes, so it's a buck. But remember, you paid $50 already, so your total profit will be $50. So you're risking $50 to make $50. This is how like the general nature of these type of debit spreads work. But then imagine if you know TLT, the zero DTE, this gives them more opportunities to do these type of trades. So if they're willing to push the envelope on this particular product, and if the SEC approves, we're talking maybe not just like additional like 1 or 2%. This could kind of rival like the kind of like another ETF that's out there, like the TLTW. So that's the covered call uh, uh, ETF. So this could be like a potential competing product if everything goes well. So this is why I think we should pay attention to this. Um, and then next, uh, like they mentioned, calendar spreads. So again, these type of spreads are good for low IV environments. Um, and these are a little funky because there's no like formula to calculate the max profit. You have to go to like these like the risk graphs and the profit and like the P&L graphs. But some traders they like to do they just want to collect theta on these trades. So this is why I showed you like a different like view of this particular trade. So basically what a calendar spread is, like imagine like the debit spread from earlier, but imagine you pushing out the short strike uh, out in time. And then calendars are basically this like a spread, but using the same price strike, but out in time. So for example, you want to short like the closer month, and then you want to buy the one that's like out in time, and then you're paying like the difference. So this would be like $82 trade. But if you look at the theta number over here, this is kind of like a good like a rough ballpark of where you want to try to collect. So you want to try to get like I would say like maybe like 50 out of like the 44 cents that's available for this particular type of trade. And then like I guess like if and when this does come out, I'll be happy to kind of like dissect the trades, um, you know, along with you guys as well. So then let's go over to like a potential diagonal spread example. So basically, a diagonal spread is kind of like a combo of what we did before. So this is a combination of a vertical spread. You can do either debit or credit, plus a calendar spread. And I think it helps to show you kind of like two examples of what you could do. And by the way, I'm using like call spreads as an example, but you can also easily do the like the put side as well. So if you look at this first one, you could short the one that's like 95 in January, and then you can go out to the next month, which is February, and then buy the 94 strike. So if this looks familiar, this is very similar to like part of like the what they do with the yield max products. So basically, you want to go out in time uh, and like buy something that's like kind of like the lower strike, and then like you want to sell something that's kind of closer in time, and that's similar to like a covered call but across like multiple months. So this is really just if you want to if it helps you to think of it that way, this is basically a yield max without the short put. And then same thing, similar concept to like a calendar spread. You're paying money upfront, and then you're trying to like hopefully collect like some data. So in this case, again, you're trying to like you're risking 133 bucks to maybe capture 53 bucks if everything goes well. And then there's other variation on this. Like instead of kind of like a covered call, you kind of this is almost like doing a in the money covered call. So this it's a little inverted. So it's a little weird for like when you first see it. But basically, you're like this it's the same thing where you're shorting something in the front month and then buying something uh in the back month. And in this scenario, you're thinking that, oh well, I want to try to get as much. I guess like the way like when people do this type of spread, they're thinking that, well, I want to sell something up front and collect the premium, but then you're hoping in like say like the back month that something goes really well, and then you're collecting, and then you potentially have like a kind of like a kind of like a lotto ticket in the back month, where like if let's say like everything goes well with this one, like let's say um, TLT doesn't go up to 95, like let's say stays around like $94 dollars. You're hoping that like, oh okay, well I think in January TLT won't do well, so that's why I'm selling the 95 covered call. But then like after the covered call, you kind of want like the TLT to go past $96, and then you can kind of like have your cake and eat it too. You're collecting like a premium in the front month, and then hoping for like the best in the back month. Let's say you're friends with G Powell, right? He's thinking, oh well, I'm gonna cut interest rate, during like the Fed meeting, but don't tell anybody. So this is like, oh okay, I'm gonna like short the 95 strike, collect that premium, and then like if everything goes well, like the like bonds will like skyrocket to like 98 or 99 or something like that, and then that's how people would try to play that kind of like scenario. But of course, like I don't encourage people to do insider trading. This is just an like a funny example. So again, like I have a lot of hopes for this. Uh, well, the type of strategy, like this particular ETF, probably won't be that exciting, but I have a lot of hopes for like what's coming like at behind this one. So maybe there's like crypto zero DTEs, individual stocks zero ETEs, and then more complex options. Because once they lay the foundation for like debit spreads and regular calendars, uh, then there's potentially we can open up the doors for even more like funky option strategies like double diagonals, iron condors, ratios, strangles, etc. Because this, like, if my memory serves me correct, this was I think what was the date on this? It was like a early November date. Oh, so sorry about that. I thought I had like the date somewhere, but well, anyway, this is still just like speculation. Uh, the SEC hasn't approved this yet. But I really have high hopes for what this could bring. So thank you for watching. If you like this type of content, please consider giving this a like. Um, and I welcome old and new subscribers. Um, like SEC dumpster diving is kind of hard work. So if you can do me that favor, because I really want to start digging deep into some of the research and analysis for some of these like future ETFs, and I really want to like bring that to you guys, especially for the general public. So thank you for watching, and I hope everyone has a great one. And please make some money out there. Bye now.